Welcome to the InterMarket Analysis video update. Each week I do a number of different videos. I do a daily video, I do a weekly video. Well, this video looks outside of the S&P 500 and looks at other indexes as well as other markets to see if we can get some insight or clarification as to what might be happening in the stock market in general and more specifically in the S&P 500. This is being prepared for Monday, August 21st. Now, if you've watched any of these videos before, I probably sound different and it probably looks a little bit different on the screen. I developed an arm injury over the past week, and it makes it very difficult for me to record videos the way I usually record them. So this is all one take from start to finish. You're going to get the flub ups. I'm going to trip over my words. I'll probably have to clear my throat. Just know that I'm not able to edit it when I record videos this way. So I ask for your forgiveness in advance. I don't know how long I'm going to have to do this, but it seems to be the best way to do things for right now. One thing to be aware of, I am offering a free online course. I haven't nailed down the actual date yet. It's either going to be one day that's 3 hours long, and then I'm going to do another class that's 3 days, 1 hour long. So I will do both. I'm basically going to teach the same thing 2 times, and it's free. There's no obligation. If you want to just come check it out, it will be recorded. So if you want to go in and watch it later, you can also do that. I'm looking at from 12 to 1 p.m. Eastern time for the 1 hour sessions. And then I haven't nailed it down yet, but from 12 to 3, when I do the longer session, it'll probably be Monday through Wednesday. I have an on again, off again commitment on Thursdays that will conflict if I want to teach on that day. I wanted to do it Tuesday, Wednesday, Thursday, but now it looks like it might be Monday, Tuesday, Wednesday. At the end of the weekend, I will nail down the actual date and then be announcing that as I'm doing the videos. What I'll be covering in the course is my approach to technical analysis, which may be a little bit different than what you're used to. I'm also going to go over some basic strategies that you can implement going beyond just buy low and sell high. And I'll also be talking about support and resistance. And I plan on an hour for each one of these areas. When we're going into intermarket analysis, the first area that I like to look at is S&P 500 valuation. How are we doing on a historical basis and looking forward? Are we expensive? Are we cheap? Are we just about right? Well, we have some different tools that we can use to kind of get some insight as to what's happening. The first area that we look at is going backwards. And over the years, the market has developed this thing called a PE ratio, the price to earnings ratio. And this ratio comes up with different values. If we are 20 or above, the market is considered to be expensive or overvalued. You can also apply this to individual stocks, but I look at it more as it applies to the S&P 500. If we're between 11 and 19, we're considered to be fairly valued, and I have to clear my throat. Sorry about that. And if we're below 10, that's when the market is considered to be inexpensive or cheap. The chart that you see right here, the black line is the S&P 500. And then we have the red line, which is a PE ratio of 20. And then the blue line is PE ratio of 15. And the green line is a PE ratio of 10. Well, we're well above the PE ratio of 20. So on a historical basis, we are considered to be overvalued. Then on the bottom, I take the current price of the S&P and I match that up with the current PE ratio of 20. And anytime we're above 0, that also just kind of shows it in a bigger picture that we're also overvalued. Now, the past couple of weeks, we've been down. So we're seeing this coming down a little bit, but we're still above 0. So on a historical basis, the market is still considered to be expensive. This is another chart just showing different events that have happened going back to 1980 and what the valuations were at that time. Sometimes we get overextended and become expensive. Other times we get more down to the fairly priced area. We don't usually get down to the green area very much on the S&P 500, but it does jockey around. Now we look at this from a big picture perspective. We don't really use this to make day in and day out, or even week in or week out, or month in, month out decisions. We just want to have an idea of where is the market looking on a historical basis, so that if we start to run into trouble, we can add that to what we're using to make our decisions to either get in or to add to a position or initiate a new position. Another thing that we look at takes more of an average over a period of time, and it's called the Shiller PE ratio. And this goes all the way back to the 1870s. Well, over on the right-hand side, we have a reading right now of 30.14. To give that some perspective, the median and the mean, which is kind of like the average price over a period of time, it's between 16 and 17. So we're getting 30.14 right now. So also on a historical basis, this chart is also suggesting that we are overvalued. But the market doesn't do that. They look forward. It's nice to look back, looking at historical values and to see what's already happened. But when you're buying stocks, you're buying what's going to happen potentially in the future. And so there are different forecasts, there are different opinions about what a company will be earning into the future. That's all put together, and there's another PE ratio called a forward PE ratio that we use. We still use that 10, 15, 20 scale, but as of the 18th, which was Friday in August, the S&P has a forward-looking PE ratio of 18.6. So we're underneath that 20 level, but we're above 15. So we would be about fairly valued. But at the same time, this can always change because forecasts can change, opinions can change, the economy can change. These are just what they think will happen going into the future, but it's what most investors use to make decisions. To get a little bit more perspective, we also look at the mid caps, and it's coming in at 13.7 currently, which that's under the 15 level. So we're a little bit below the fair value calculation for right now. We also look at small caps, been getting hit kind of hard lately. They're now coming in at 13.5 on a forward-looking PE ratio. We put all of this together in this chart. We have the S&P 500, the 400, and the 600, just to get some perspective as to where we're at with all the different indexes. Then we also have two different indexes for small caps that we look at. The Russell 2000, which is the red line, and it's kind of its own little thing. You can see that the value is a lot different than the other values we were looking at. And then we also look at the S&P 600 small cap index, which it's at 13.9 right now on a weekly basis. And so it has come down quite a bit, but both of these are considered to be a little bit under fairly valued at the present time. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high. Value is what you get into when you think the market's going to run into some difficulties. We saw a real shift from growth into value in 2022. And as the market was really under a lot of pressure and going down, the value stocks, they didn't always go up, but they would go down less than the growth stocks. The growth stocks are like Apple, Microsoft, Google, the big name companies that people want to buy at a low price and sell at a high price. And we compare how they're doing with each other, and we can get some insight from that. The first thing that we look at is a pure growth index. Now, it's been in a downtrend going back to 2022, but right now we're starting to see a golden cross with this daily chart showing that growth is showing some improvement. It had been looking more weak, but then it came to a point where it started to show some strength. Lately, as the market's been running into some trouble, we have been coming down overall, but we're still turning more positive. We compare that to value, which also has been down for most of 2023. It bounced back up, getting close to generating a golden cross, but it's not quite there yet, and value has been trailing off recently. Where we get some insight is when we compare the two with each other. On the top, we have the growth to value ratio, showing that growth is outperforming. And on the bottom, we have the value to growth ratio, showing how value has been underperforming. The reason why I do a lot of inverse charts, and I have a lot of charts that you might think, well, he's just showing me the same thing in 4 or 5 different charts. They all calculate a little bit differently. And to get confirmation, we want to be able to see the same thing happening at the same time. You can see on this chart where the moving averages crossed slightly different from each other. And if you're at a point where you're trying to make some decisions, this might be a little bit confusing, or you might wait too long, or you might pull the trigger too fast. Now we have some other growth to value ratios that we look at. We look at some ETFs of the S&P 500 showing how growth is starting to outperform value. Then we look at how value is underperforming growth. This is just an inverse of that same chart. We look at some indexes. We take the pure growth to value indexes and make it longer term, showing how growth is starting to outperform value. And we're also in an overall uptrend with this ratio. Then this chart looks at a little different thing where we take the value to growth, showing how value is underperforming. And then the last chart is another index where we look at growth to value, showing how growth is outperforming. And that's why the market has been doing better in 2023. We need growth to outperform value. We also use some different studies just showing a growth to value ratio where growth has been doing quite well, but it's seeing some recent weakness as it had been improving. Then this is an inverse where we look at value to growth, where it has been declining, but seeing some recent strength. We also look at the small caps and we compare small cap growth to small cap value, where it's been seeing some weakness lately, but if you look at this longer term, it's still in an uptrend. I usually have some moving averages on here, but they didn't come through to this chart. We also look at mid cap growth to value, which has been a lot stronger in 2023, but it's been going sideways to slightly declining in more recent times. Then we look at the growth to value ratio for the S&P, and this is probably the one I focus on the most. Longer term, we're still in an uptrend. The blue line is above the red line. But in a shorter term time horizon, we've actually been more in a downtrend after we have been going sideways. What we're seeing right now is growth starting to outperform value. This developed later in the week, this past week, as the market's been having some trouble. But we want to see this continue to go up. That gives us hope going forward. This means the smart money is coming in and buying growth stocks when the market's going down because they know that later on the market's going to go back up. If we see this roll over and start to go down, that would be more warning signs that maybe we need to get more defensive. We also keep an eye on inflation. We look at a monthly chart of the CRB index. This is commodities. And then on the bottom, we have an inflation to deflation ratio. While on the top, we have been declining with the CRB index. It has been seeing some strength. It got above its moving average, but this past week, this past month, it has been showing some weakness. Then on the bottom, with the inflation to deflation ratio, it has been declining, showing that inflation is underperforming deflation, and we're dropping below the red line, which is a moving average, and the red line continues to decline. So for this chart to tell us something, it suggests that inflation is not out of control right now. We don't want this to go down too fast because deflation is not necessarily a good thing either, but the market is more fixated on inflation these days. Here's the CRB index with a daily chart that we look at, where in 2021, we were in a strong uptrend, but then getting into 2022 and into 2023, it has been coming under some pressure. However, lately, we're seeing a surge back with the CRB index, and we're getting ready to potentially see a golden cross as it's been showing some improvement, but it hasn't quite crossed yet. We also look at the Baltic Dry Index. This gives us an idea of how much does it cost to ship something from one place to another, generally in the Baltic areas. And when this is going up, that tends to mean that the prices to ship things are going up. And when this is going down, that means the prices to ship things are going down. And we continue to be in an overall downtrend. Some other markets that we just look at. We're not really involved in these markets. We just want to keep an eye on them. Here's aluminum, which is in a downtrend. Then we have corn, which is in a downtrend. Wheat, which spiked up, but now is starting to go back down and is in an overall downtrend. Keep an eye on fertilizer. It had been in a decline, started to bounce back up, but we're seeing some recent weakness. Oil, which this is very influential in all of our lives. where we're starting to go back up. We haven't quite come to a golden cross yet. We were down around the 70 area for a while, and now it's starting to come back up. It got into the 80s, and right now we're in the 75 area. Gas, another area that's pretty important. We're seeing this in an overall uptrend. It's been really choppy, but gas tends to go up in the summer, and that's what we're seeing right now. Although you probably feel the pain for this every time you fill your tank. We also look at diesel. How much does it cost to ship products around is also based on diesel prices. Trains, trucks, these things all use diesel, where it has been in a decline, but we're seeing it starting to go back up recently. Heating oil. Don't really need much of that right now, but in the winter it sure comes in handy. It's really declining, but starting to come back up, but we're still in an overall downtrend. Natural gas, another thing that's heavily used, also in a downtrend. We also keep an eye on copper. Copper's like a barometer of the economy. If copper's going up, that usually, in a general sense, means that we're looking better economically into the future. If copper's going down, that means we're seeing some economic potential weakness in the future. Well, we had been in an uptrend, but now we're starting to see a death cross with copper where the red line is above the blue line, and that's suggesting that we might see some weakness. Now, this is a little bit contradictory because we've been getting a lot of economic reports lately that have come in stronger than expected. So we'll just kind of keep an eye on this. But we also compare this to gold. Generally, in a very general sense, when the copper to gold ratio is going up, that means economically we're tending to look better going forward. That means copper is outperforming gold. Well, when gold starts to outperform copper, that usually means, in a general sense, that we're going to have some economic weakness. Well, the copper to gold ratio had been in a downtrend earlier in the year. It's been chopping sideways and it's starting to underperform. It dropped below the moving average, but we're seeing copper starting to outperform as gold has been running into some difficulties. This is a longer term look at that same chart. The black line is the copper to gold ratio going all the way back to 1980. We also plot the 2-year yield and the 10-year yield. So we have interest rates on here. And you notice for the last 20 years or so, they've had a tendency to go in the same overall direction, and they tend to not get too far apart from each other, even though they're on different scales. Right now, we see the copper to gold ratio pretty much going down, where interest rates are going up, and the spread between all of these is really quite wide. So this just shows some of the economic uncertainty that we've been seeing. And we've been seeing this for quite a while now. This started to develop back in 2022. And as we're going forward now, we've been seeing this wide spread and that they're not necessarily going in the same direction. We do look at gold where it's still in an uptrend, but it has fallen down below its 200-day moving average. We're also seeing that same thing with silver in an uptrend, but now it's below the 200-day moving average. We look at gold on the top. This is just the closing price for gold. And then we compare it with silver in the middle. And then down below, we see that there's a really strong correlation between the two. Generally, if gold's going up, silver is also going up and vice versa. But we can get some additional insight from this gold to silver ratio. That's what we have up on top. And then down below, we have the US dollar index. And in a very general sense, when the US dollar is going up, which is what it's been doing lately, gold outperforms, when the US index is going up, gold does outperform silver. I just want to make sure I got that right. And that's what we've been seeing right now, as even though gold and silver are under some weakness, this is turning down just a little bit, suggesting that gold is in the short term underperforming just a little bit as well. And then when the US dollar index is going down, which is what it was doing as stocks were going up, silver tends to outperform gold. Now, they can both be going up or they both can be going down. It's just which one is performing better. And we see the correlation between the two on the bottom. That measures the ratio between gold and silver on the top, and then takes that ratio and compares it to the US dollar index on the bottom. So that means we can have a fairly high level of confidence that what we're seeing on this chart is what's actually happening. I hope I did a good job explaining that. I got a little mixed up there. The dollar, after dropping below 100, has just been roaring back, and it's coming back up to its 200-day moving average. The interesting thing is, if you look at the weekly chart, we're almost getting ready to see a golden cross. We're not seeing that here. The moving averages are quite far apart from each other, but that means the other moving averages on the weekly chart are a lot slower. But to see this happen is not what we usually see. We usually see the daily charts turn positive first, and then the weekly charts follow that. Well, we're just seeing a reverse of that right now. Then we compare the US dollar to the euro, where the euro has been declining lately compared to the dollar. We also look at the Japanese yen, which has also been going down as the dollar's been going up. Here's a standalone chart of the Japanese yen to the dollar, where it's been underperforming and is in a downtrend. The British pound, though, is still hanging in there. It's falling back a little bit, but it's only come down to the 50-period moving average. Some different index ratios. How are the biggest software companies doing? Even though we've seen some weakness, they're still in an overall uptrend. A little bit of a concern, though, that we drop below the 200-day moving average. The big stocks, the mega cap stocks, the Apple, the Google, the Microsoft, the FANGs, all the big ones that everybody loves to talk about and try to own. We're seeing some weakness now after they've been really going up strong in 2023. We're still in an uptrend, but we did drop below the 50-period moving average. We look at the robotics and AI ETF. That's the rage right now, and everybody wants to get into that, but look at how it's been performing. It's really showing some weakness. When we compare it to tech, when we take a ratio between the robotics and AI ETF and compare it to the tech sector, it's really been underperforming and really hasn't broken out for much of 2023 for all the hype that we've been hearing about AI. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities together and puts them into one average. It looked like we were starting to break out here, but now we're seeing some weakness and we've dropped below the 50-period moving average. We look at the S&P 500 and compare it to shorter-term bonds, where we had been outperforming with the S&P, but as the S&P has been pulling back, it's coming back into this rainbow. We look at a broad market measure, so not just the S&P, but looking at all of the stocks across the market and compare it with further out bonds where stocks have been outperforming, but we're seeing some recent weakness. Low volatility stocks, which held up fairly well in 2022, they've been continuing to go sideways overall, seeing some recent weakness, but they're still in an uptrend. But when you compare them to the S&P 500, they are really outperforming. They are really underperforming. We look at the tech sector and how's it doing compared to bonds. Tech had been doing quite well, but we're seeing some recent weakness right now. We look at the S&P 500 and compare it with other stocks where we have an advanced decline line studies here, where we show the NYSE dropping below its moving average, the S&P also below its moving average, the mid caps and the small caps. All of these are showing some weakness. They had been holding up fairly well until later in the week when each of these indexes started to drop below the moving average. So we're seeing some weakness in the market. We also look at traditional Dow theory, which just takes the Dow and compares it to the transports. I also add utilities at the bottom, where we were breaking out with the Dow and now we're starting to come back down. The transports, which when the transports do well, the economy tends to be doing better. They were breaking out and actually outperforming, but now we're seeing some weakness as well as we come back down to this breakout level where utilities have been under a lot of pressure and continue to show weakness. We look at a ratio between the transports and the S&P 500. When this is going up, that means the transports are outperforming. When this is going down, that means the S&P is outperforming. In a good, solid environment, we want to see this ratio going up. Well, as the market's been pulling back, we're seeing this ratio going down. We look at the Dow and compare it to the transports and take a ratio. When this is going up, the Dow is outperforming. When this is going down, the transports are outperforming. And so this has been going down lately, meaning the transports have been outperforming, but we're starting to come back up more in the short term, suggesting that the Dow is outperforming the transports. We also look at the correlation between the two. We look at the Dow and the trannies. We look at the S&P 500 and the transports, And we see that the correlation between the two is quite strong. So that's why we want to keep an eye on the transportation index. The FANG stocks, these are the big ones, the Facebook, Apple, Amazon, Netflix, Google. They're still in a longer term uptrend, but they did drop below their shorter term 50 period moving average. That's more intermediate term. And then we came back and set an all-time high with the index, with the FANG index, and then we've been falling down ever since that time. So that's some of the profit taking that we're seeing right now. ARK, which seemed to be all in love. Everybody loved ARK there for a while back in 2020 and into the early part of 2021. Well, now everybody seems to hate it, even though we've seen a recent golden cross with this ratio. So it's in an overall uptrend, but we are seeing even more shorter term weakness. Then there's a new take on Dow theory. So instead of using the Dow, which is 30 stocks, we look at the S&P 500. That's more of a representation of the US economy. And instead of looking at the transports, which at the time it was developed meant the railroad stocks, we look at the NASDAQ because we're more influenced and we live in a tech type of world now where we're seeing the breakout with the S&P 500, but now some weakness. We'll be wondering, is this level going to hold if we continue to fall? We've also been seeing some weakness in the NASDAQ after it had been breaking out. Then we look at the S&P 500 on a monthly chart, showing that it's in an overall uptrend, and we compare it with the stocks in Europe, Australia, Asia, and the Far East, showing that the S&P is outperforming. We take a ratio of that. We also have a momentum oscillator down below showing that we're coming above zero. So longer term, we're still looking positive when you compare the US stocks as represented by the S&P 500 with the stocks in the rest of the world. Then we also keep an eye on bonds. We're seeing some difficulties here. We haven't quite crossed over negative yet with the total bond ETF, but it has been seeing some weakness as interest rates have been going up. The World Bond Index, we're starting to see a death cross here as it's dropping below the support level. But when you look at a monthly chart, stocks are continuing to outperform bonds. Also, on a daily chart, we're seeing how bonds are underperforming stocks even though they're turning up slightly. Then we look at high yield corporate bonds. These are junk bonds. They've been holding up quite well right now and are in an overall uptrend. Investment grade bonds, a little bit more conservative. They've been showing some weakness, but they're still in an uptrend. So we compare the two, riskier bonds like junk bonds, and compare them with more conservative bonds like government bonds and corporate bonds. Folks are still tending to prefer the riskier bonds because they give you a better yield. They don't mind taking on the added risk. And this is usually indicative of a positive market, even though we've been hitting some difficult times lately. We look at a correlation between stocks and bonds and showing that they're having a slight tendency to go in the same direction. When we're up at this level, the closer we get to one, the closer that relationship is 1-to-1 in the same direction. If we drop below this red line and the closer we get to -1 means they're going in opposite directions of each other. We look at the Dow Jones Corporate Bond Index showing some recent weakness, but still been going sideways. However, it's in an uptrend. Keeping an eye on the 10-year yield. A lot of fuss has been made about this. We're starting to break above previous highs. This is the interest rate that is tied to the bonds, and this has been putting pressure under stocks as interest rates have been going back up. We also look at another chart of the 10-year yield where going back to 1980, we saw a series of lower highs and lower lows as interest rates were going down. Are we starting to see a shift in this relationship now? Are we going to be getting into a period now where we're going to see higher interest rates, which is what we saw back in the 70s? Then we keep an eye on the 30-year yield. It's still above the 61.8% retracement level and climbing, and could come and take out this recent high that we saw back in 2022. Interest rates going up, that's putting pressure on stocks. We look at a ratio between the S&P 500 and the 10-year yield, where stocks have been outperforming, but as interest rates have been going up, the Dow is really starting to underperform. Junk bonds also hanging in there and still in a longer term uptrend. We compare junk bonds with government bonds, showing how junk bonds are really outperforming. And that's the way it should be. If you're willing to take on more risk, you should get more of a reward. But if we were starting to really run into difficult times that were longer term, this ratio would probably not be going up. We keep an eye on a daily chart of bond prices where they're going down as interest rates are going up. We've seen a death cross recently based on price. We have the RSI, which is below 50, even though it turned up slightly. That's negative. And the MACD down at the bottom also suggests that the momentum is negative. We look at yields where they were really going up this past week, although we did see them come back a little bit in Friday's session. Here's a weekly chart looking internationally with the UK having the highest rates, followed by the US in green, and then blue is Germany. Japan is its own little story now, and they're purposely keeping rates low. This has a story attached to it, but it seems to be under control for right now. If it comes to the surface, I will be talking more about that. We look at the 5-year yield. Now, this is the interest rate attached to the 5-year bond, where it's in a longer term uptrend. But when we look at the special K, which is a momentum oscillator, a very long term momentum oscillator, it continues to be in a downtrend. When we look at the KST, another longer term momentum oscillator, we're starting to see this go back up slightly as rates have been going up. We also look at the 5-year yield again. It's above this moving average, suggesting that interest rates are still in an uptrend. But when we look at different KST oscillators in the short term, it's starting to suggest we're going down. In the intermediate term, we're going up, and in the long term, we're going down. So this really isn't helping us all that much, even though this is a weekly chart. We haven't been seeing a lot of changes here. Now we look at the longer term bond ETF based on price, where it's been going down. In the short term, intermediate term, we're in a downtrend. We're still looking like we're in an uptrend in the longer term. Then we look at the MOVE index, which measures the volatility of bonds. In the middle section is the VIX, which measures the volatility of stocks. And I do a lot more studies of this in the daily videos that I do. What I want to show here is the correlation between the two. And right now, they don't have a real strong correlated relationship, but they're having a slight tendency to go in the same direction. Then we look at the price of the 30-year bond, not the interest rate, but the price, and we compare it to the CRB index. And this is a monthly chart where we've been showing a decline. We're below the moving average, but when you compare it to the CRB index, bonds are outperforming the CRB index. We look at different sectors. We have the materials sector and compare it to the S&P 500. It's in a downtrend. Communication, which has been a stronger area in 2023, is still in an uptrend. We look at energy, which really underperformed for a lot of 2022. It's starting to make a comeback. And with this ratio, it's coming up to the 200-day moving average. The financials, been hearing about the banks and all the different weird things that have been happening. Well, the financials have been really underperforming the S&P. The industrials also in a downtrend compared to the S&P. Tech, that's been a real darling in 2023. It's still in an uptrend, even though it's been pulling back lately. Staples, which held up fairly well in 2022. These are the things that you have to have. Well, in 2023, they're really underperforming the S&P. Real estate is still really underperforming the S&P and in a pretty significant downtrend. Utilities also, as I showed in the Dow theory chart, also in a downtrend compared to the S&P. So this is one area that we look at, and this is what I call part of the possible positive scenarios. When the S&P is outperforming utilities, this often gives good support to the S&P. This ratio has still been going up, even though we've been seeing some weakness in the S&P lately. Healthcare, another defensive area. You have to have healthcare no matter what's happening economically. It's in a downtrend, but it has been bouncing back up lately. Here's another look at healthcare, where it's showing how it's underperforming the S&P, but bouncing back recently. We look at discretionary. These are the things that make life fun. It's actually been doing quite well in 2023, but we are seeing some recent weakness, but it's still in a longer term uptrend. The staples sector, just all by itself, the things that you have to have, it's still in an uptrend, but we're seeing some weakness. We look at the tech sector, really doing well in 2023, but dropping below its 50-day moving average. The semiconductors, also in a longer term uptrend, but pulling back below the 50-day moving average. Then we compare the tech sector to the S&P, where the tech sector has been outperforming, but it's been pulling back lately. Then we compare energy, which did great in 2022, and compare it to tech. Well, it's really underperforming in 2023, but it's in the last couple of weeks, it's really been starting to outperform again. Growth stocks and compare them with bonds. Growth stocks continue to outperform bonds. The tech sector to the rise in interest rates, where the tech sector has been in a longer term uptrend, but seeing some recent weakness. Here's an inverse of that same chart showing how interest rates have been underperforming tech. Discretionary to staples, and we do a lot of different studies with this. Again, kind of a hybrid of this would think you maybe think of growth versus value. When discretionary is outperforming staples, that tends to be more positive for the market. And it is in a longer term uptrend, but we're seeing some recent weakness. Then here's an inverse of that same chart showing how staples have been underperforming discretionary. Gold, which everybody thinks should be gone to the moon by now and on its way to Mars, it's really underperforming the S&P. Even though when we look at that chart, it's in an uptrend, it's really underperforming stocks right now, and we're seeing a death cross in this ratio. We're also seeing it underperforming the dollar, as the dollar's been seeing some recent strength. High leverage loans, these are risky loans. And I say this every week in this video, if we were getting ready to fall off a cliff with the economy, there's a lot of smart people that follow this market and they know what's going to be happening. Do you think we would see as strong of an uptrend as what we're seeing right now? I highly doubt it. This would be going down if the economy was getting ready to really suffer. Now that could always change, but we've been seeing that for quite a while now. We also compare small caps to the S&P. That's the red line where small caps are underperforming. We want to see this red line going up and the blue line also going up. They both have been going down lately. The NYSE composite. This is a broad market measure of what's happening. It's in a longer term uptrend, even though we're seeing some weakness recently. All stocks, not only US stocks, but looking internationally, in an uptrend, recent weakness. Emerging markets, been chopping more or less sideways, but we're still in an uptrend. Bitcoin, which broke above 30,000 there for a while, really started to fall back and is now into the mid 20s or so, around 25 or 26 over the weekend. Keep an eye on the home builders, where we've been seeing a decline with the S&P. The home builders have been declining, the ratio is declining, and the relationship is quite strong between the two. We're looking for some kind of divergences or convergences in this chart, and we're just not seeing that right now. Then we look internationally, where across the globe, everybody's really suffering right now. China, emerging markets, Europe, Japan, and the US are all in downtrends when measured by the KST oscillator. We look at InterMarket Analysis, the name of this video, going back to the beginning of 2023. Stocks are doing the best, and then we're seeing a real conglomeration here. Oil is the red line, starting to show some improvement. Gold and the dollar are the gold line, and the and the green line here for the greenback, where the one that's negative now are the price of bonds. Some correlations, just to give us some insight. We compare the S&P to the dollar index. They're having a pretty strong tendency to go in opposite directions. So if the dollar's up, stocks are down. If the dollar's down, stocks are up. And we've been seeing that pretty heavily over the past week. We compare S&P to oil. They're having a tendency to go in the same direction. Comparing the S&P 500 to the 10-year yield, they're tending to go in opposite directions. We compare the tech sector to the 10-year yield, also opposite directions. And then shorter term yields with the S&P 500, also opposite directions. Then we have a long-term secular, which means decades long study that we look at, and then some cyclical trend studies, which are more shorter term. They might last a few years. This is a monthly chart of the NYSE where it's declining right now, but it's still in a longer term uptrend. It's above its moving average. The Copic curve, which is another momentum oscillator, is starting to cross above zero and is positive. We also look at the NYSE on a daily chart and use a thing called the NYSE record high percent index. Even though this is falling back recently, this going up is more positive for the market. Then we look at the S&P on a monthly chart, and we also see the oscillator down below showing that we're still in an uptrend. We compare the S&P to the CRB index, also showing that stocks are outperforming even though we've seen some recent strength in the CRB index. Then we look at the S&P 500 on a monthly scale or monthly chart and look at a global index showing how we're still above this red line. So the S&P is doing well, but the KST is still suggesting that we're in a downtrend. I'm not quite sure why that is, but that's how it works out. So at the very end of this video, I go through a list of what is positive. And my definition of positive is when the 50-period simple moving. Okay, let me try that again. When the 50-period simple moving average is above the 200-period simple moving average. This is a new addition to the list. The growth indexes, we've seen a golden cross lately. The biggest software companies are in an uptrend. The euro and the British pound compared to the dollar, gold and silver, mega caps, low volatility stocks, the Dow Jones Composite Average, the FANG index, as well as ARK. Bonds, even though we're getting a little close to some death crosses with some of the different bonds that we look at. Staples, even though they've been chopping sideways. The tech sector and semis, even though they've seen some recent weakness. High leverage loans, that's kind of a big clue about what's happening economically. The Dow, the mid caps, and the small caps are still in uptrends. The NASDAQ and NASDAQ 100, the NYSE composite, the all stocks looking inside the US as well as internationally, emerging markets, and then Bitcoin is still in a longer term uptrend. Okay, what's negative? This is when the 50-period simple moving average crosses below the 200-day simple moving average. The value indexes, even though they're close, they haven't quite seen a golden cross yet. The CRB index showing some improvement, but not enough for a golden cross. Copper also showing a recent death cross, and the dollar, which on the weekly chart, as I said, is starting to look more positive, but we still have a ways to go on the daily chart for a golden cross. And then the Japanese yen when compared to the US dollar. Microcaps, I didn't show a chart of that, but these are the real smaller companies. They're doing okay for right now. Thank you. I hope you found this helpful. And again, I apologize for my flubbubs and lack of being able to edit this. I hope you found this video useful. Please feel free to check out some of the other videos that I post. I hope that you have a great weekend, and I will talk to you in the next video.